Hi guys, welcome back to the channel. So today we are going to be discussing something that is very important that everyone who wants to get involved in the stock market must put in place before they start investing in the stock market, because if you don't do any of these things I want to mention in this video, the chances that you are going to lose money in the stock market is very high. And we have seen this played out a lot of time, judging from the questions that people ask me and narration of their experience in the stock market. So if you don't want to lose your money in the stock market, then this is the video for you. So before you start investing in the stock market at all, there are certain things that you need to put forward, because putting these things forward will prepare you for the journey ahead, which is stock market investing. And the end goal of stock market investing is to make money. If you want to make money, you need to do these things. And if you don't want to lose money, you still need to do them. So I have 4 things for you. The first is financial literacy. Before you start investing in the stock market at all, you need to be financially literate about how money works. You need to understand some certain numbers, income, expenditure. You need to understand all of these things before you now say, yes, I'm ready to start investing in the stock market. Because the first thing is that investing in the market is you investing in a business, because the moment you buy a share of a company, you are now a part owner of that business. So if you are not literate or you are not educated about how the stock market works, and you now start putting your money in the stock market, what will be the end? The end will be you losing your money. So that's the first step. The first step is understanding what you want to get involved with. If you understand how the stock market works, you know that you buying a share is owning a piece of a company. You know that if you do this, you are going to make money. If you do this, you are going to lose money. That's the first step you need to do. And the good thing, in this day and age, there are a lot of resources that you can learn about how the stock market works. You are watching this video on YouTube. There are so many videos on YouTube as well that you can watch that will teach you a lot about the stock market. There are so many podcasts that have been done about this topic that's going to help you in this journey. What about books? A lot of books have been written about this topic. So that's one step. You need to understand how stock market works before you put your money there. Putting your money in the stock market should be the last thing to do. It should come after you understand it. Because this is one thing we have realized with so many people. In fact, it's not just about stock market, about all businesses in general. People just want to make money. They just log into Twitter or log into Instagram or TikTok and they see somebody talking about a particular business. And the person is saying, I made certain amount of money. Before they even understand what that thing is all about, they are already investing in it. And what will be the end? They will lose money from it, because they don't even know how they are making money, how they are generating money for them to make money in that business. So you need to understand it first. In fact, this goes beyond just understanding it, because if you strive to learn about how market works, you will also strive to learn about whatever you want to put your money in, how it works. Does it align with your value? All of these things are important before you now put your money there. Putting money should be the last thing. There are so many books that have been written. I have some favorite book. You can read The Psychology of Money. It's one of the greatest books that has ever been written about the topic. If you are keen on early retirement as well, you can read Simple Path to Wealth by J.L. Collins. And books like The Richest Man in Babylon as well. It doesn't just talk about the stock market, but it gives you a guideline on how you can save, how you should invest, and all of those things. So you can read books like that as well. What other book? Another book you can read is The Almanac of Naval African. This is all encompassing. It talks about business, leverage, compounding. Everything is inside this book. And also, there is one book by Scott Galloway. It's called The Algebra of Wealth. So if you read that book as well, it helps, and it talks about the stock market a lot inside that book. Also, the book of Ramit Sethi, I Will Teach You to Be Rich, is a good book. Podcast, one of my favorite podcasts is The Diary of CEO. Especially the episode he did with Morgan Housel, who is the author of Psychology of Money, and the episode he did with Ramit Sethi. If you watch those 2 episodes, you are going to understand this topic the more. And don't play with YouTube, guys. Search on YouTube, just search the word stock market, and you are going to see so many resources that you'll be thinking, wow. So we have all of these resources here, and I've been playing. So guys, that's the first step. When you now finish learning about how the stock market works, then you can now start putting your money there. Now, the second thing that you need to put in place before you start putting your money in the stock market is having an emergency fund. This is so underrated when it comes to investing, but it's one of the most important things to have before you start putting your money in the stock market. Why is emergency fund is important? We all know that as human, emergency is going to happen at one point or the other. It's a matter of when. It's not about if. It's going to happen. But when it happens, do you have a buffer to fall back to before you start investing? Because look, stock market investing that you want to dabble into, it's something that is unpredictable and is an emotional game. It's deal with fear and greed. So if you put your money in the stock market goes up and down. Now, when emergency happens to you, nobody can say this is how the stock market will be doing at that time. So if you now put all your money in the stock market and emergency happens to you at a time that the stock market is not doing well, what are you going to do at that time? Then you have to sell your investment at a loss. That is something you don't want to happen. So that is why it's so important to have a buffer which will protect you from selling your investment at a loss. And that's what you are going to use when emergency door happens. So now, the question I will now get after this will be, how much should I have in the emergency fund? There's a rule of thumb, and it's that you should have at least 3 to 6 months of your living expenses in your emergency savings. So now, majority of people won't be able to save 3 to 6 months of their living expenses or have it at once. But some people have it. If you have it, good. Just put that money aside. That's money for your emergency. If you don't, start with little amount. If you are somebody in the UK, start with £1,000. If you are somebody in Nigeria, start with £100,000. Obviously, depending on your living expenses. So if you start with £1,000, your goal will now be to be adding to it every single month till you get it to the point that you need 3 to 6 months. That's how to do it. So that's how to build an emergency savings. And this is so important. Don't miss it. I've seen a lot of people do this. And based on my own personal experience, the stock market is so unpredictable that nobody can say what's going to happen next week or even next month. So don't play like that, because if you now go and put all your money in the market, two things are going to happen. Either emergency happens and you sell your investment at a loss, or this will push you to be making a rational decision. Take, for instance, you have Mr. A, who has £10,000 as a net worth. Everything he has minus his liability is £10,000, right? You have another person as well who also have the same £10,000 as the net worth. Mr. A puts all the £10,000 in the stock market. Mr. B puts £3,000 in the emergency fund and puts £7,000 in the stock market. If the stock market dropped 50% and Mr. A's money dropped to £5,000, Mr. B's money will drop to $3,500. Meanwhile, he still has his own emergency fund. The person that doesn't have emergency fund, there is a high chance that that person will make an irrational decision when market dips like that. But the person who has an emergency fund knows that no matter what, I still have a buffer. That person will not make an irrational decision. That is why having an emergency fund is one of the most important things that you need to have in place before you now say, yes, I'm ready for the stock market. 3, having a long-term mindset. When you are investing in the stock market, having a long-term mindset is so important. And this is one thing that you should have, because if you approach the stock market as a get-rich-quick scheme, there is a high chance that you are going to lose money doing it. You can't approach the stock market as a get-rich-quick scheme. There is a difference between a trader and somebody who is an investor. If you are investing, it means you are working with a long-term horizon. If you are a trader, that means you are working with a short-term horizon. But majority of traders, in fact, when you log into any trading app, the first thing you see there is that 90% of people that do this lose their money. So majority of traders lose their money, and it's only professionals that actually know what they're doing, can read technical analysis and do all of those things that should be traders. Every retail investor who is not a professional should be an investor. You should work with a long-term horizon and invest in a diversified portfolio. So if you approach stock market with long-term mindset, at least 5 years, I've never seen anyone who invested consistently for 5 years and that person lose money. That's my own. I've never met anyone like that, except that person did not invest consistently. But if you invest consistently for 5 years, I've never met anyone who is at a loss within a 5 years horizon. So Invest for at least 5 years. Have that mindset that the moment you are putting this money in the market, this is money I'm willing to put away for that long. That goes to also say any money you want to use for a short-term goal, you want to buy a house, you want to buy a car, that money you are saving for those kind of things, those sort of money is not money to put in the stock market. Because if you put this sort of money in the stock market, remember, like I said, the stock market is unpredictable. You don't know what's going to happen, whether market is going to be up or down when you need your money. What if the market is down at that time you need your money? What happens? You're going to have to sell at a loss, except you have other money somewhere else sitting. So guys, having a long-term mindset, it is so important in this journey. And before you start, that's one of the things you should consider. Now, the last thing is, if you have a lot of consumer debt, some of these consumer debt have a high interest rate, and that is ridiculous. The best thing would be to sort out your debt before you now start investing in the stock market. I'll tell you why I said that. The benchmark for the stock market is known to deliver at least 10% over the long time. Now you have a high interest rate debt that you are paying 18 to 20% on. Essentially, if you pay off those debts, that means you are making money than what you are going to make in the stock market. But many people have ways of doing this. That's why I said sort out your debt. Someone will say, this is the way I'm going to do it. I'm going to be investing a certain amount, and I'm going to be using this certain amount to pay off my debts. They will have a time frame for those debts and say, if I put this amount there, I'm going to finish paying it at this so time. They set a goal like that. And on the other side, they will be investing together at the same time. Another person will say, I will focus first on those debts, tackle it aggressively, pay off the debt, and then I'm going to start investing in the stock market. Either way, just find a way to sort out those debts as soon as possible, because just as compound interest works with you making more money, it's the same way it works when you have high interest debts. Compound interest works the same way. So guys, these are things I think you should put in place before you now say, yes, I'm ready to start investing in the stock market. If you don't want to lose your money, first, seek education. Learn about how the stock market works. 2, have a long-term mindset before you start investing. 3, have an emergency fund. If you have an emergency fund, it serves as buffer for you. 4, sort out your debts. If you sort out all of these things, remember, these are before you start. And this is the mistake that majority of people make. They don't prepare for all these things. They just go and dump their money in the market. Dumping your money in the market should be the last thing. So if you find this video interesting, kindly like, share, and subscribe to the channel. And do comment as well if you have questions. And if you have something that you want me to discuss, just put it in the comment section and we are going to discuss it.